everyone present here. Myself, Advait Harikumar. It is my immense pleasure to welcome once again Harish sir onto this platform of Menon Mantras. So, like I said in the previous session, Harish, the last corporate role Harish sir had was for a bank named ING Vaisya Bank Limited as their chief economist. Then he has conducted training sessions across the globe in countries like Sri Lanka, Philippines, Doha, and so on. He has taken in Dubai also. So as long as I could reminisce, the initial sessions of Harish sir was regarding planning of financial growth. I think that was the first session he has taken for our Hunger Collective session. So then he has subsequently he has taken sessions on financial market, also one special session on how to invest in foreign markets, which would probably be new to at least a few percentage of our viewers. Then one beautiful session was regarding asset allocation, and in that session, I remember sir mentioning about fund sizes, the rate of interest, the rate of risk which each fund schemes give us, and how to effectively allocate our assets, which is actually a very important life lesson as well. Um, so it is a prerogative to introduce you once again to this session, sir. Namaste, Harish sir.
Thank you, Advait. You remember a lot of things about my sessions, which is interesting. Good evening, Anil sir. Thank you so much for this opportunity again. Good evening to all of you. Good evening to all the participants also. Today is a little technical session. Last time I spoke about basics of call options and put options. Today we are extending on that and getting into what is essentially known as option strategies. It is, as I mentioned last time, also not for everybody. So it's not like the first thing that you do by entering into financial markets is to do options. It's not for all. But once you understand this product, once you are able to use it effectively, there are a lot of advantages of it. There are a lot of things that you can do with this. I will give you some examples of some of the strategies that you can do in today's session, and then hopefully if you have any questions I can answer that also. If you want me to explain anything else during the session, do let me know. You can mention in the chat box whatever questions you have, or in the Q&A box. I usually either use a PPT. In my initial sessions I was using PowerPoint. Then I think last couple of times I used Excel. Today I thought I will get into showing you a website. This is the website which I had told you last time in Monday session. I thought I'll actually take you to this today, which is called Sensible. A very efficient platform for anybody who wants to use options and do any trading on that. I hope my website is visible to all of you. So it's a very simple website. You have free subscription also if you want to, or if you want to use their advanced features, then there's a subscription model also that you will have. Let me explain to you. So the idea is not to show you the website. The idea is to understand various aspects of option strategies through the website. So website is just a tool. It will make my life easy in terms of explaining to you how it will work. Let's just create some dummy strategies. So we will look at multiple things, right? So again, as I said, I'm not getting into the website features because that's not my objective. But once we discuss certain strategies, what will happen is that you will be able to see what is called as payoff chart directly on this. So you'll be able to visualize how that strategy will look like, and where will the profit be, how much will the profit be, how much will the loss be. So it's easier to see it because it's all live. It's, when I say live, the market is closed, but every data that you see, the premiums, the margins, everything will be exactly how it will be if you trade in the market. So If the market was live, then obviously you could have traded also, but now you cannot do a trade because the market is not live. So I spoke about a couple of things in my Monday session. Let me start from there. The first thing which I said on Monday was, let's assume that you're looking to buy a particular stock, right? Now let's assume you have always been looking to buy Reliance, for example. Okay, now the moment you click Reliance, it will show you the Reliance futures price. Futures price is a little more than the spot price usually. So you can see the Reliance futures price approximately 2000. Now you want to buy Reliance, you are willing to purchase Reliance stock in your portfolio, but you are not willing to purchase it now because you think that maybe markets will correct. Maybe Reliance is slightly overpriced. It it fell by 1.4% today itself. So you are not very sure whether you want to buy at 2000. You're saying I want to buy at, let's say, 1800, for example. Your expectation is that you want to buy at 1800, right? So what you can do is you can sell. So you can see there is futures, there is call, there is put. You can sell for the next month expiry, which is 26 November. What you see here is what is called as strike prices. Strike price is the price at which you can buy or sell in an option. So in call option, you have a right to buy. In put option, you have a right to sell if you buy the option. So strike price is the price at which the settlement is going to happen. Now let's assume you want to buy at 1800. You're very happy to buy at 1800. So you can see here Reliance 1800 put. I'm not sure whether it has taken the put. So you can see Reliance 1800 put. Today when the market closed, the premium was approximately 21 and a half. You can decide how many lots, and suppose you want to do just one lot, right? Now if I say add, and the reason why I'm using this website is because we will be able to visualize what is going to happen. You can see the quantity here for one lot is 505. Minus means I have sold the Reliance put option, because I'm saying if the price of Reliance goes up from here, I anyways will not buy the stock because I'm waiting for 1800 to buy the stock. But while I'm waiting, I can collect premium also. So 505 quantity times 1800, you're willing to buy that much Reliance. See, if you want to only buy one Reliance equity share, one or two or five, then all this strategy is not for you. The strategy is useful if you have a portfolio and you are willing to invest 505 quantity of Reliance, which is approximately 9 lakh rupees. So if you want to invest 9 lakh rupees in Reliance, while you're waiting for Reliance price to fall and you don't know whether it will fall or not, you can simply sell 1800 put and collect this premium. You'll earn this 21.5, which is per stock, and you have sold 505. Now if I click on analyze, it will open up a page where it will show you where is your profit, where is your loss, etc. It's a little slow when I connect to Zoom. So again, the website will show you a lot of features. I am not getting into that. This is how the payoff chart is going to look like. This is called payoff chart. So how do you interpret this? On your x-axis on this side, if you see 1600, 1700, 1800, these are the prices of Reliance on expiry. Expiry is 26 November. So let's assume Reliance is at let's say 2100 rupees or 2200 rupees on 26th of November. Then what will be your profit or loss in this particular option? So what have you done? You have sold a put at 1800. Sold a put, which means your counterparty has a right to sell Reliance to you. So you will buy from him at 1800 if the price is below 1800. So that's what you want. If the price goes below, I am willing to buy Reliance at 1800. I'm very happy. And while I'm happy to buy at 1800, I'm actually earning a 21 approximately premium also. 21.5 times 505, you see the premium, the profit is 10,800, which is nothing but the premium. So let's assume in the next 1 month, Reliance does not go down to 1800. Reliance just hangs around in the range of 2000, 2100, 2200, etc. And you have money. You have that 9 lakh rupees. You are also, but not fund. So you're earning some interest on that 9 lakhs, and you're willing to invest 9 lakhs, which is 505 quantity of Reliance, whenever the Reliance price goes down. That is your expectation. So in November, let's assume Reliance did not go to 1800. It stayed anywhere above 1800, anywhere. You will make this profit of 10,000 odd, almost 11,000. And understand, on 9 lakhs, if you are making 10,000, 11,000 rupees in November, you have just made, if you understand, more than 1% for the month. If Reliance does not go below. Now, you can obviously say that, oh, but what if Reliance goes to 2200? Then you will not get any profit of Reliance because you never bought Reliance. You are not comfortable buying Reliance now, right? That is the starting point. You said, I will buy only at 1800. So I am giving you a solution. While you're waiting for the price to go down, why don't you sell a put? Now, what is the side effect of this? What is the good thing? The good thing is, while you're waiting, you will earn 1% on your money. Actually, more than 1% if you think about it. Now, the thing is that suppose you do it every month. Let's assume every month you try and do the same thing. And on an average, every month, if you earn 1%, please understand you have just got 12% premium per annum. And you've got your FD or whatever liquid fund income also. So you already got your to 14-15%. Now, I think if you can earn 14-15% without actually taking any risk, it's not a bad idea, right? So you can do this. Now there will be margin that will be blocked, by the way. You can see here. There's something called capital required. So 1,60,000 margin you have to block. You anyways have 9 lakhs, right? Out of that 1,60,000 you can just use as margin. Option buyers pay premium. Option writers, I'm writing an option here, I'm selling an option. The side effect is what? Let's assume November turns out to be a disastrous month. Let's assume that November is like a very pathetic month. The market just crashes and absolutely goes down. And let's assume Reliance goes to 1600. Just bloodbath. Reliance crashes as low as 1600. Now, if you had not done this, if you had not done all this sell, put, etc., what would have happened is, as the price went from 2000 to 1600, you actually could have bought Reliance at 1600 also. You could have actually bought Reliance at 1600. Here, what will happen is, the moment Reliance goes to 1600, if you can see here, there will be a loss on your option, if you see, of 90,000 bucks. What is that 90,000? It is nothing but 1800 minus 1600. In other words, you will effectively you'll end up buying Reliance at 1800. Your effective cost will be 1800 only. But you should remember you are happy to buy at 1800. So you can't like have the best of everything. You need to sacrifice somewhere something. So if you're okay to not buy Reliance at 1600, and if you're saying no problem, I'll still buy at 1800. And in all the scenario when Reliance is higher than 1800, just imagine higher than 1800, Reliance currently is 2000 plus. You're earning 10,000 bucks on an investment of 1,60,000. So if you consider it that way, on an investment of approximately 1,60,000, you're earning 10,000 something. That is a return of 6.78% for a month. What I calculated as 1% is on your entire 9-10 lakh rupees that you were keeping idle to purchase Reliance. Also, a lot of people kind of, what if Reliance goes to 1600? Same point I mentioned. My only counter logic to that is when Reliance goes from 2000 to 1900 to 1800 and you are happy to buy at 1800, what will give you the comfort to not buy and keep on waiting? Because how do you know it is going to 1600? At 1800, how do you know it is going to 1600? You will be like, wow, it's already come down by 10% from 2000. Let me buy. So that's the idea. You want to buy a stock, and Reliance is an example. It could be any stock that you're looking to buy, and you can just earn some good premium income. I'm not talking about cheap premium income. I'm talking about almost like 1% on your 10 lakhs. And if you do this for, let's say, 2-3 months, you've already earned perhaps 20 and then another 20 and then another 20. You would have already got 60-70 bucks as premium. That is all reducing your actual cost of buying Reliance. And then you hold on. Once you buy Reliance, you hold on. Whatever was your investment logic of buying Reliance, you hold on to that. This is how, as I said, you can use options in a little bit logical way if you want to, and optimize your buying decisions. This is one thing which I wanted to show you. Let me show you the next thing. The next thing which I showed you last time was on a covered call logic, right? Covered call. So let's assume you have a mutual fund portfolio of 10 lakhs, 20 lakhs, 40 lakhs, 50 lakhs, whatever. The portfolio has gone up. The mutual fund portfolio has done very well. But you realize that now probably the market is going to enter into a resistance zone. You don't expect the market to go further higher if you think so. What you can simply do is, I'll add one more. You can sell Nifty if you want to sell the entire market. You can sell Nifty call option. Call. Now this is, you're giving away your upside. And if the price corrects, you will have some kind of a premium income. So 26 November, currently, if you see Nifty is 11,700 and odd, today is closing. You think that it may probably go till maybe 12,000 only. It will not go above that, let's say. So you can sell a call of 12,000. You will collect a premium of 171 for one lot. Okay. Now understand, one lot is 75 Nifty. So 75 times 12,000 is 9 lakhs. So if you have a 10 lakh rupees mutual fund portfolio or equity portfolio, one lot is good enough. If you have 20 lakhs, 2 lots. If you have 30 lakhs, 3 lots. So whatever calculation we are making is on 9 lakhs, which is one lot of Nifty. And then you sell, right? Now what happens is, I'll show you the payoff chart. So I repeat, you've sold 75 quantity Nifty, 12,000 call. Currently market is close to 11,700. So you're saying up to 12,000, I want my upside, but after 12,000, I don't expect the market to go up much. And you've collected a premium. Now, if you see how the payoff chart is going to look like, this is how the payoff chart will look like. I will take it to the expiry. Right now, this is how the payoff chart will look like. What does it say? It says if Nifty is below 12,000 anywhere below 12,000, because you remember you sold a call at 12,000. So above 12,000, somebody else will make a profit and that will be your loss, because I repeat, you're an option writer. But if you're saying market may not go that much, market may remain range bound or go down in November, it is just for 1 month, you will earn 12,800 rupees premium anywhere it goes. So even if Nifty goes to 11,000, 10,000, wherever, you will earn this 12,844 rupees premium on a 9 lakh portfolio, on an investment of 9 lakhs in Nifty, which is your equity holding. 12,800 is, if you can imagine, 1 point something percent for 1 month. Now, is this hedging? No, this is not hedging. This is only a way to earn some rental income on your portfolio. While you're holding the portfolio, you're earning a rental income of 1 point something percent. Because see, on a 9 lakh rupees equity exposure, you're selling one lot. 1% of 9 lakh is 9,000, and here you're collecting 12,800. So I hope you understand, you're talking about maybe 1.3% or something like that. Now, suppose Nifty is range bound, it just plays around in a range. No problem, you will still get your 12,000 rupees for this month. Next month, you want to sell a 12,200 call, you can do that. So depending upon Nifty, you can take 300, 400 points higher and sell that call. What is the side effect? The side effect is, if Nifty just zooms, suppose in November Nifty goes to 12,500 or 12,600 or whatever, in this option you will have a loss. You'll have a loss, as you can see, of 32,000, 35,000 loss. But do remember, you have a portfolio. So I'm assuming that portfolio would have gone up substantially when Nifty went from 11,700 to 12,500. That is, let's say, an appreciation of 7-8%. So on your portfolio, hopefully you would have got 7-8%, but out of that, this much loss you will incur. So what do you have? You will have lesser profits if market zooms up, but you will have lesser losses when the market is range bound or going down. This is called a covered call strategy. You will have a profit if the market is range bound or it falls. Like you saw this month, market went up a lot. It went up from, I think, 10,800 level to all the way up to 12,000, but it could not cross 12,000. It went again lower, again went up, again went down. So it is staying in a range. And while you stay in a range, you will be able to collect this much premium, which is one lot. If you have a 1 crore portfolio, you don't want to do all the 1 crore covered call. No problem. You sell 5 lots. 5 lots is 45 lakhs of Nifty. Your portfolio is 1 crore. Market zooms up. On the 45 lakhs of Nifty, you'll have a loss. Opportunity loss because your portfolio is up anyways. On the remaining equity portfolio, you'll have a good profits. There is no covered call against that. Suppose market is range bound, you will make 5 lots of this 12,000. So you will make around 60,000, 70,000 rupees profit in that particular month. How much is 60, 70,000 rupees on 1 crore? That is 0.6, 0.7%. If you get 5 to 6 months in a year, 5 to 6 months of 0.6, 0.7 extra percent, you have earned your 3 to 4% extra returns, which is called as alpha. You're trying to beat the market in multiple ways so that your overall portfolio returns may be little better than what it would have been otherwise. So this is a call that you can. I am not sure how technical all of this thing is or how confusing all of this thing is, but as I said, options are not for everybody. If anybody has any questions, please feel free to ask also. I will show you more examples of what you can do with options. There are multiple things. This is single put and single call, right? One put, one call only you have used. What else can we do? Let me show you. Now, let's assume you are of a view, and this is all view based. See, I am not telling you how to develop a view because that's a different session altogether. There can be a separate session on technical analysis, how to read a chart, how to know whether market is overpriced or underpriced, how to look at open interest, how to look at put call ratio. There are a lot of elements to decide whether market looks to be range bound or something. So if you have a view, all of this is fine. If you don't have a view, then you can use it for covered call. You can, as I told you in Reliance example, you can earn premium while you're waiting for the prices to go down. So you can do all those things also as a fundamental long-term investor. You can optimize your portfolio, but be careful because if you're new to it, it might be a little tricky. We do it a lot. My job is to advise investors on wealth creation. So we do it a lot. We do it for a lot of clients. In fact, before I came to this page, if you saw, there were so many portfolios mentioned. So we keep doing certain trades to earn extra returns for the client. Now let's assume you're talking about a range bound market. You have been watching the market and you are assuming that, you know what, market has gone up. Market is kind of now at close to 11,700. There is nothing happening. November is a very tricky month because there will be US elections and all that. So your view is that market is going to be range bound. Range bound means it will neither go up too much nor it will go down too much. So this can be a view on a stock also, on a particular stock like SBI or whatever. So let's say your view is on, let's say SBI. Just let me change the example to SBI. Again, you need to have a view. If you don't have a view, then obviously you are gambling, right? I am not telling you how to gamble. If you're like, how to take a view about SBI, that's a different story. I mean, that's a different discussion. If you have a view on SBI, if it's a stock that you have been tracking, currently at close to 190, you can see the stock price is close to 190. You think that SBI has some positive news, negative news, NPAs are there, FIIs may bite, but it will still be in a range. It will not like move out a lot. So what you can do is you can sell a call on the higher side, which is called out of the money, and sell a put on the lower side. saying that SBI will stay in that range, and you decide the range. Let's assume you think SBI will, in the month of November, not cross 220. Currently it's 190. So you're saying it will not cross 220. So 30 rupees on 190, if you understand, is more than 15-16%. 1 month, 15-16% upside you're trying to cover, because 10% of 190 is 19, and you have 30, right? 30 rupees higher you're selling a call, 220 call you're selling. What is the premium? Almost 3 rupees. Almost you sell. SBI lot size, by the way, is 3000. Quantity is 3000. So you see 3000, almost 3 rupees you have sold. On the lower side, and now I'm adding one more strategy, one more trade. On the lower side, you're saying it is 190, right? It may go down, but it will not go below, let's say, 170. You think it will not go below 170. Let's assume. Again, you need to have a view. It is not like you can randomly put a number and assume that it will be fine, because then you're gambling. You can look at charts, you can look at supports, resistances, a lot of things you can do, and then say, what if your view is price will not go below 170? So 170, put, sell. Premium is again close to 3 rupees. You add. Now you're selling to option. This is technical jargon, if I may use. This is called selling a strangle. Strangle, that's the word we use, strangle. You're selling a strangle. 220 call you're selling, 170 put you're selling. This range of 170 to 220 is your comfort zone. Your view is SBI will not break this range in November. If the range is broken, you will have a loss. How much loss? We will see. But if it is in this range, you will make profit. How much profit? The premium that you have collected. So let me show you. Let me show you the chart. I mean, I said, I don't know how heavy all this is for you, but I'm just hoping that there is some value addition out of these sessions. This is the chart. Right now, this is how the chart will look like. So if you see, what's happening is, in a big range, this, if you see, is 170, the starting point of the range, and this is the ending point of the range, 220. So if you see, between 170 and 220, which looks like a decent 50 rupees range, and SBI currently is here, by the way, where you see this green line. So if it goes down, you're saying it will not go technically below 165, because that's your break-even point. Remember, you have collected premium. So technically below 165, and if it goes up, it will not cross, let's say, 225. In November, only this 1 month coming up. You can see in this range, you will make a profit of 17,550 rupees. Why? Because you have collected premium, almost 6 rupees you have collected, almost 2.9, 2.95, almost 6 rupees. 3,000 times 6 is almost 18,000 you're collecting. Now you're selling to option, there will be margin. You can see 1,60,000 rupees you have to block. Margin. 1,60,000 rupees you have to invest in this trade. The broker will take 1,60,000 rupees from you. What is the break-even point? 164, 225.8, 226 roughly. Break-even means beyond that, you will have a loss. Your loss will start. And by the way, loss can be scary. So if SBI goes to, let's say, 240, big move from 190, it is going to 240. Understand, it's a 25% move in SBI in 1 month. If you have SBI stock with you, awesome. Then you don't have to worry, because SBI anyways in your portfolio will go up. You can see there's a loss of 42,000 rupees. So you have to always understand what is the loss and what is the probability of that loss. Like, what is the probability that SBI will go from 190 to 240? I would say it is not a very probable thing. I mean, even if it happens in November, do one more time in December. See, every month it cannot go up by 25%, right? क्या बोल रहे हैं हम लोग? SBI, it's a public sector bank, with all due respect. Its profits is anyways not there, making NPA. How will it go up by 25% every month, every month, every month? So people who sell Strangle, you have to keep doing it. It's not like a life may one time kind of a trade. People like me, we keep doing it. We look at a range where we find comfort, we sell it. Now understand, if it's in this range of 170 to 220, you will make around 17,500, which by the way, on your investment of 1,60,000 is a 11% profit. 11% profit. Now, what am I saying? Understand, 11% profit is crazy in a month. Please don't have unreasonable expectation of 11% a month. Come on. You can't be doing a business expecting 11% a month. If you are doing option trading as a regular thing, you should have reasonable expectation. What is reasonable expectation? 15% per annum is reasonable. 2% per month is brilliant. If you can make 2% per month consistently, please understand you will be one of the best traders in the world. 2% per month consistently. So 11% is too high. Who's expecting that? At least I don't expect. Now let me show you something interesting. What I showed you is as on 26 November situation. Now let me drag the date to something like 5th of November, suppose. Closer to today, 5th of November is just few days away, right? 5th or 6th of November, let's say. Now, let's assume in the next few days also, SBI is in a range. SBI is not moving out, in a range. Let's say between, if you can see, 175 on this side and on this side 205. In this range. This blue line that you see is the profit on this date, 7th of November. So on 7th of November, you can make something like, if you see the blue mark, 7,000, 7,800, 8,000 rupees or something. Let's assume 7,000 rupees. Your investment is 1,60,000. In about 10 days or 2 weeks, if you can make 1,60,000 on that, if you can make 7,000 something, I hope you sincerely understand that is a crazy rate of return. What is the risk? I repeat, it is not a risk-free trade. The risk is SBI just blows, either on the lower side or on the higher side. I don't know how many of you track the markets very closely. There was a time where SBI on one day, just one day, went up by 40%. Just in one day, it went up by 40%. So in one day, if it goes from 190 levels to something like, let's say 240, 230, understand, you're talking about a 55, 60,000 loss. You need to be able to bear that loss. Telling that it is not going to happen every time. Understand, it is all about probability. What is the probability? What is the likelihood that every time you do this, SBI will keep jumping up by 25, 30% in one day? I mean, what is the likelihood? If you have never seen an SBI chart, it is very range bound. It just sticks to a range. ITC, I don't know if any of you invest in the market or if you have ITC. ITC has been absolutely like in a big range for a long period of time. People are like very frustrated. It doesn't move at all. So you can pick a range, whatever is the comfort level. Now, I repeat, this range is giving you, by the way, a profit of almost 17,000 bucks on 1,60,000. That is 11%. If you want, what you can do is, I'll tell you something. You want to play safer. You want to go much safer. You know how you go safer? Instead of selling a 170 put, you keep going down. You go and sell a let's say 50 put. You're going farther away. You're saying that if SBI goes till 150 also, you have no loss. 150 from 190, please understand, is a 40 rupees move. So you can sell that. I'll tell you what will happen because of this. And on the call side, and you can see the premium has gone down because the lesser the risk you take, the premium obviously will go down. And on the call side, let's say you go further away and instead of 220, you go to, let's say, 250. Farther away, 250, let's say. Which means till 250, you have no loss. 250 from 190, right? Now, if you see the total premium that you are collecting has gone down, it has gone down substantially. No problem. Let's look at it. 0.8 plus 0.8 is 1.6. 3,000 times 1.6, you will make close to 4,800 rupees profit. Your maximum profit now is 4,800 rupees. You'll see this. 4,900 rupees because you have collected 0.8 plus 0.85, 4,950. Let me round it up to 5,000. What is the range? The range is 150 and 250. Now understand, we are in October 28th. In 1 month from SBI 190, it has to cross 250 or it has to go below 150. Now it's a 100 rupees range. If you think it's a safe range, your investment is 1,10,000. Your margin also will go down. Your maximum profit, if things go well, is 4,950. You know what is the return on investment in 1 month? 4.5%. Do you think 4.5% in a month with a probability that you're looking at of a good chance of making that money, 4.5 is bad? Obviously, it's not bad. This is something which is possible. But I repeat, if SBI for whatever reason goes from 190 to 290, understand at 290 you will have a loss. You can lose. But you have to understand that probability. How many months you will have movement of 190 to 260? It's a big move. Next month, if it is at 260, do it again. So the point is, it's a business, right? When you're doing a business, you will have losses. COVID के वजह से 2-3 महीना loss हो गया, let's say for a Titan, but they come back. In good seasons, you do more business. So the point is, you have to do this consistently. You have to know the stock. Don't do it with, I mean, if you don't understand the stock, if you don't have any view, you're gambling. And I repeat, I'm not talking about gambling here. It has to be some familiar idea that you have about the stock. So you can sell this. This is called selling a strangle. You can do it with Nifty also. Suppose you believe Nifty will be in a range of, let's say, 11,000 and 13,000. That's it. You think this is a big range. Sell a 11,000 put, sell a 13,000 call. Anywhere between that, you will have a profit. If it breaks that range, if you have a portfolio of your own, and if Nifty goes to 13,000, please be happy about it. If you already have an equity portfolio or a mutual fund portfolio and Nifty goes to 13,000, please be happy about it. Let me show you what will happen if you do it with Nifty. Nifty range, and again, you can decide whatever range you want. Do remember one thing, Nifty gives you lower premium as compared to stock because Nifty moves less as compared to a stock. If you know, SBI can go up by 50% in 1 day also. Nifty will not do that. So the premium will go down for you. I will show you 26 November. Call, right? Upside. Suppose you say Nifty will not cross 12,000, let's say 600. 12,600 Nifty, almost close to all-time highs. Okay, you add, the premium is 28, by the way, almost 28. And if you have an equity portfolio yourself, if Nifty goes to 12,600, I hope you know most of your stocks will be up by 10% or so. So if you have a 1 crore portfolio, you will definitely make 10-12 lakhs just on that move of Nifty. Remember that. Now on the lower side, you are saying, you know what, Nifty will not go below 10,000, let's say 10,000, 500, just a expectation. Today it's at 11,700, 10,500 means 1,200 points lower. Add. Right? So 10,500 and 12,600 is your range now. This is the range in which you will make money. If it breaks the range, there will be a loss. What is the return on investment we are talking about? So you're collecting approximately 55 rupees, 27 plus 28 is 55. 75 is the lot size. So 75 times 55 is your total premium income, which as you can see here, at the end of 26th of November, your maximum profit is 4,200 rupees. Let's assume 4,000 rupees. 4,000 rupees. What is the range? 10,500 on the lower side and 12,600. Suppose it goes to 13,000. If it goes to 13,000, your loss will be 25,000. Imagine you have a 50 lakhs portfolio or a 20 lakhs portfolio or a or a 30 lakhs portfolio. If Nifty goes from 11,700 to 13,000 in 1 month, understand your portfolio would have gone up by 10 to 15, 20%, assuming you have the right stocks. So a 50 lakhs portfolio will already give you a profit of like 10, 20 lakhs, 10 lakhs, 12 lakhs, 15 lakhs profit. What is the loss here? 25,000. Is it likely that it will go here? Obviously not. What is more likely is this range will be crossing. And that is why if you see there is something called probability of profit. So based on historical movement of Nifty, there is a 84% chance probability. See, it's all about estimate. There's a 84% probability that market will be in this range. What is your investment in the trade? Your investment in the trade is 1,16,000 rupees. On that, you are making around 4,200 rupees. What is the return on investment for a month? 3.66%. If anybody can earn 3% consistently, that is 36% per annum. And if anybody can earn 36% consistently, he's God. He's God. If anybody can earn 36% consistently, he's God. At least to my mind, is God. So there will not be a illogical 3.66% expectation. So what you should do is, you should be more realistic. Suppose 10 days after you start or 12 days after you start, Nifty starts to go up. Nifty starts to go up to, let's say, almost 12,000, right? We have done the trade. We are going towards expiry, which is 26th of November, but we are now on 8th of November, if you see. And Nifty has started to go up. Nifty is moving up. Now you have two choice. Now you have to take a view, like from 12,000, is it going to cross 12,500? Because you're going closer. If you're confident, if you're like, nahi, abhi upar jayega, but it will come down also, I am confident, you wait. But if you're not confident, you can still exit and make a profit of 1,500 rupees. This will be the profit on 8th of November, not end, 8th of November, 1,500. What is the harm of earning 1,500 on an investment of 1 lakh 16,000 or something? That is still 1%. That is still 1% for about 10 days. What is the problem of earning 1% for 10 days? Now, I'll tell you what mistake people do. I'll tell you. This is one lot, right? They will look at this profit of 1,500, many amateurs, many beginners, and they say, 1,500 is nothing, man. I mean, that's just my eating expenses of a day, right? So what they do is they want to make more money. They want to make 15,000 rupees. They sell 10 lots. The problem of selling 10 lots is if a circuit is hit. Suppose tomorrow a news comes that, let's say, India-Pakistan war has broken out. You never know. Market can go to 9,500, and you know what is your loss per lot? 78,000. 10 lots, 8 lakhs wiped away. What was the profit you were looking for? 15,000. What was the loss you will make in a disastrous once in a year kind of a situation? 8 lakhs. There is no proportion. 15,000 versus 8 lakhs. What is the logic? So the discipline to tell yourself that I'm happy with 1% and I'll keep doing this. It's a donkey job. It's like you have to keep doing the small job, small job, small job. And then you earn 12%. You have your portfolio also. You earn 15, 18% in a year, which is exactly what we do by doing not only this strategy. This is only one of the things. We can do a lot of things. We can make it more risk-free also by doing more complicated things. But the idea is that you keep earning consistently by keeping a probability of profit high and the profit amount low. I can show you strategy where you can make 20% per month also, but your view has to be absolutely bang on. Like you're saying, Nifty will be between 11,700 and 12,000 only. You sell 11,700 put, you sell a 12,000 call, you can make 20% return on investment in 1 month. But if it breaks, and there's a big chance it will break, 300 points is nothing for Nifty. It can break in 2 days also. What is the range in this? The range is 10,500 to 12,600. What is more likely to break? The smaller range is likely to break. So understand, one is probability of profit. The other is the actual profit you can make. This is also something which we can do if you want to. And you can keep on looking at, what will be the profit tomorrow, day after. You don't have to wait for expiry. So if you're active in the market, if you have 1 or 2 hours where you can track, good. But I repeat, this is all range bound. If you think the market will be range bound, if you think the market will break out, then obviously this strategy is not for you. You can do the reverse also, which I will tell you. I'll explain to that. The reverse one. Reverse one is, if the movement is big, you will make a lot of profit. If the movement is not big, you will have a loss. You can do the exact opposite of this. That's also up to you. There's a question from Mehul. Mehul is asking, what if Nifty crosses my limit and comes back in the range? No, if you have continued, Mehul, in the position, suppose I took a range of 10,500 and 12,500. It went to 12,800, but you did not square off the position. You kept on holding it. There will be a mark-to-market loss, MTM. There will be a loss temporarily, but you held it. And the Nifty went back to, let's say, 12,200, for example. You will make your original, whatever profit you were looking to make, whatever it was, the original profit. But in between, there will be a mark-to-market loss. And what is mark-to-market loss? You have to pay the broker for that loss. And we are sitting at 8:18 p.m. 8:18 p.m. I'm in an air-conditioned room. It's easy to say that you wait and things will come back to normal. When Nifty actually on a day will go to 12,700 and you know that your range was 12,500, with all due respect, I want to tell you that you will panic. You will panic because at 12,700, what is your conviction it is going to go down? What if it goes to 13,000? What if it goes to 13,500? For that extra 2,000-3,000 rupees profit, you may end up with a loss of 1,20,000 per lot. So panic makes us do things which is not very logical, right? Under panic, we don't think straight. But if you wait, it will come back. Then obviously you will make whatever profit you are hoping to make. Whatever that 4,200 rupees or something you will make. But your mark-to-market loss could be, let me see what is the mark-to-market loss. Let me actually see. I'll answer your question, Mehul, about daily part also. Yeah, mark-to-market is daily. Every day the P&L will be calculated. So if you see, this is the chart, right? Now let's assume we have reached 11th of November and Nifty has gone to 12,700. Okay. Your loss on 11th of November is 14,000. So you have to pay this. And obviously you have not gone there directly. You would have gone slowly, gradually. So whatever is the loss. So from here, if you go here, whatever is that day's loss, you have to pay that day's loss incrementally. And on a daily basis, it happens. And if you go to 12,700, and let's assume at 12,700, you're at a loss of 14,000 rupees if you see. Now, you have two options. One, you exit, eat that loss of 15,000 because you had a bad month where Nifty moved so much. And now if you don't exit and if you say, it is going to come back, that is conviction. Because if it indeed comes back, suppose over the next few days, market comes back, you will definitely reduce your loss and make profit also. But what if it goes here? What if it goes further higher? In fact, it is not even showing that level. What if it goes to 13,200? Just an example. You're now sitting on a loss of 40,000. So you have to think, whether you're okay with that loss or not. It's upon you. Nobody will force you to exit as long as you're paying the mark to market. I hope that answers your question, Mehul. Most welcome. On the day of expiry, we have to square off the position or system will do it automatically. Good question, Amit. If it is a stock option, stock, SBI, Reliance, Infosys, the settlement is on gross settlement basis, gross, which means if you have a call bought, if you have a buy call, if you have bought a call on SBI and the price has gone up, you're in profit. But if you go into expiry, then you have to actually purchase 3,000 quantity of SBI by paying whatever is the purchase price. You have to actually get the stock. That is called physical settlement in stock. So it's better not to go into it. A day or two before the expiry for stock options, you have to ideally square off, because otherwise you will have to either give the stock in put or take the stock in call. If you're okay buying 3000 SBI by paying 9 lakh, 10 lakh rupees, no problem. But otherwise, it's not a good idea to go into that. Nifty or Bank Nifty, two index we have. I would recommend not to trade on Bank Nifty. Bank Nifty is a punter's index, punter, speculators index. I would strongly urge, if you're new to the market, do not touch Bank Nifty. The kind of movement Bank Nifty will give, आपका बीपी बढ़ जाएगा. आप अगर ब्लड प्रेशर नॉर्मल है आपका, वो बढ़ जाएगा. Don't touch Bank Nifty if you are not intending to speculate like a player. If you are a passive investor, if you just want to earn maybe a little bit, try out something. Be with Nifty. Nifty is not that crazy as compared to Bank Nifty. Bank Nifty is super crazy. In a day, it can just move by 2000 points and you will not even, the market will not even blink because of that. So I would recommend not to do with Bank Nifty. But Bank Nifty and Nifty both are what is called as cash settled. You just leave it on the expiry, it will automatically get settled. You don't have to do anything about that. But stocks, you have to exit. Otherwise, you will get into gross settlement, which means you'll have to take the stock or give the stock. I hope that answers your question, Amitji. Let's assume your view is a little different. You have a view on Reliance or whatever, Infosys. Infi is a bad stock for this example because IT stocks don't move that much. But again, view. You need to have a view. If you don't have a view, whatever we are discussing is futile. Infi, okay, now let's assume Infi is currently trading at, as you can see, 1100, approximately 1080, 1080. Okay, and you are saying that Infi, and it happens sometimes in a stock on charts, it kind of goes into a small range. It just stays in a range, continuously stays in a range, and then a lot of traders will say, you know what, it is not going to break the range. बहुत time से it is range bound, it is now dying to kind of break out either on one side or the other side. So you are saying from 1080, Infi will give a good 10-15% move, but you don't know which direction. Maybe US election result is coming. It can move either this side or that side. So what you do is you buy, call, which strike price you select, because 1080 strike price, you have to pay 42 rupees premium per stock, 42 rupees. Suppose you are saying I will buy 150, for example. 11, let's say 50, which is 18 rupees premium. You're buying, not selling, you're buying. So no margin. There is no margin requirement. You have to pay the premium. You have to actually pay the premium. I repeat, you are at 1080 approximately. Above 1150, you'll have a profit. Above 1150. You can just leave it at this. If you want to just do one side, you can do this. Or if you're saying it will go down also, I want profit. Suppose it goes below, so you buy a put. Buy a put. So if you're saying if it goes below 1000, so 1080, 1000 is 80 rupees away, almost 8%. Below that, you have to pay a premium again. So you're paying two premiums. You're paying 18 bucks and you're paying 12 bucks. You're paying 30 bucks. You're paying 30 rupees. What is the lot size? 1200. One lot of Infi is 1200. So 1200 times 30 is 36,000. So you have to invest 36,000 rupees. No margin, no 1 lakh, 5 lakhs, nothing. 36,000 rupees your investment. But if Infi does not move a lot, you'll have a loss. You'll have a straight loss if Infi just does time pass. See, this is how the payoff chart is. So on 26th November, if Infosys is between 1000 and 1150, which is a very reasonably big range, you will have a loss of 37,000 rupees loss. But obviously, if it goes above and it breaks out, if it actually moves very high, your profit is unlimited. Now, the problem is that it's 1 month. Market can be range bound. So if you can look at historical data suggests that the probability that Infosys will break this range is only 33%. There's only a 1 out of 3 chance. Now, what is the benefit of doing this? Your maximum loss is limited. You know that worst case your loss is this 37,000 rupees. You will never have a loss of more than 37,000 rupees. That's it. But if suppose in the next few days, just in the next few days, because of election result, infy starts to move up. Suppose infy goes to 11,1150, which is by the way about 70 rupees higher, you can make a profit of 18,000 rupees. On an investment of something like 37,000, 18,000 is 50% ROI, 50% ROI. See, if infy doesn't move, you have a loss of 10,000. Look at the blue line now. The brown line is on expiry. Expiry is 26 November. Blue line is what will happen on this date. See this date. So suppose 6th of November, infy is still at current price of 1,060, 1,070. You have a loss of 12, 13,000. But if infy goes below 1,010, your profit will start. So you can see on both the sides. So this is how the payoff chart will look like. You can see. So this is a strategy which is called buying a strangle. Buying. Earlier I showed you selling. See, the same thing you can do ulta. Sell the call, sell the put, everything will get reversed. You will earn the premium. In a range, you will make money. If the range breaks, you will have a loss. Now you can imagine how you want to do it. It all depends upon the view. This is about a view. These are all range bound or direction level trades. One side, either side, both sides, up to you. Now let me show you one last thing that is very useful, which is called spreads. Spread means range, right? Let me show you what I'm trying to say. Let's assume you are, your view is on Nifty bullish spread, Nifty bull spread. Your view is that Nifty will go above 11,800. Now, if you're asking me, what if I don't have a view? Then obviously you can't do much. Currently, Nifty is 11,720. You can see 11,720. You're saying Nifty will go in the next few days or couple of weeks, it will cross 11,800. So you're buying a 11,800 call, which will be very expensive because it's very close to the market. Is there a decent probability that it will cross 11,800? Of course, there is a decent probability. So the premium you pay is 257. You're paying, by the way. So 75 times 257 you are paying. Anything above 11,800 is your profit. Anything above that is your profit. But what you're saying in your head is, see, I am not expecting Nifty to go to 12,500, 13,000. No. I am saying even if it goes up, it will not cross, let's say, 12,000. So you're saying it will go above current level. It will go above 11,800. It will not cross 12,000. So you again sell a call now of 12,000, receive some premium, collect some premium. You collect 170. So what am I saying? I'm saying it will go above 11,800 but not cross 12,000. So you know what will happen? If it goes up and crosses 12,000 also, your maximum profit will only be this 200 bucks minus the premium that you are paying. You're paying a premium of approximately 80 rupees here. So you buy a call wherever you think price will cross, and if you think price will not cross a certain level, you're selling that call. This is called a spread. Why it's called a spread? You're having a range bound view. You're saying that market will go in this range of 200 points only. What is the advantage? Less loss, less profit, good ROI, very less margin. Margin requirement is very less. ROI can be very good if your view goes wrong, view goes right, and even if view goes wrong, it will not be like a huge loss for you. This is a very good starting point for anybody. This is how most beginners should start. This is how it will look like. So you're here, this red line. If it goes below, if it just falls, your maximum loss is 6,500 rupees. Maximum loss. Worst case, you will lose 6,500. Your view goes right, it goes up, it crosses 12,000, your profit is 8,500. Again, that will also be maximum 8,500. This is called a spread. Spread means a range. So you're saying Worst case loss 6,500, best case profit 8,500. It's a good 1:1.2 ratio of risk reward. Brilliant. This is what a lot of beginners do. And there is a 43, a half chance, right? Because that's logical, right? Either Nifty will go up or Nifty will go down. Or kya hone wala hai? So there is a reasonable chance that you will make money. But max profit is also limited. Max loss is also limited. And there is a decent chance that you will make profit. In fact, if Nifty starts to go up, even in between, just think about it. In the next few days also, if Nifty goes up, your profit will start. See, in the next few days also, if it touches something like 12,000, you already made a 2,000 rupees profit on an investment of 6,500. On an investment of 6,500, 2,000 rupees profit, my dear friends, is about 30%. 30% in something like 8 days. And it's not like you're taking a huge risk. What is the worst case? Nifty goes down and crashes down, Pakistan attacks India, something very bad happens. Worst case kya hone wala hai? You're going to lose 6,500 rupees per lot. Suppose you're like, I can lose more than that. I am okay to lose 20,000 rupees. You do 3 lots. If you do 3 lots and Nifty goes up, and if it goes up even in the next few days, you can make 3 lots pay something like 6,000-7,000 rupees. On an investment of 20,000, if you make 6,000-7,000 rupees, I think it's a brilliant trade that you have done. So these are the things where without, and suppose you don't have time, you are not like, I cannot watch the market every day. No problem. Worst case क्या होगा? Suppose आप 10 दिन के बाद market में वापस आए. You came back on 11th of November and market has just gone down. It crashed. It has just crashed. It's gone to 10,500. No problem. What is your loss? 6,000 rupees. It's just crashed to 10,000 levels. No problem. 6,000 rupees. So these are the trades for beginners who do not want to lose a lot, and the ROI is good. I mean, brilliant ROI. If your view goes slightly right, you make a lot of money. And if your view goes wrong, you don't lose so much that you will regret. And you can do another trade. Kabhi na kabhi to right jaoge. So you can always have trades like this also, which can have a very good probability of making profit. See, again, it's about probability. Plus loss. I mean, are you willing to take a unlimited loss? Then do a strangle sell. I just showed you SBI 150, 250 range is like a very big range. If you are comfortable, no problem. But remember, if you break that range, the loss is unlimited. So if tomorrow some news comes about SBI, some crazy news that there is a major fraud or something, and SBI goes to 120, then aapka neend ud jayega, because then you are maybe working somewhere and you have no mind space because you're suddenly on a mark to market loss of 30,000, 40,000, 50,000. In a spread like this, when you do a spread, kya hoga? Worst case, what is happening? 6,500 per lot. Achha, best case is also not like you will become a millionaire overnight. You will make 8,000 rupees. But not bad, right? I mean, by investing 6,000, even if you can make 600 rupees, what is the problem? 600 rupees on 6,000 is 10%. Never look at absolute. Never look at absolute. आप बोलोगे 600 रुपया क्या होता है? अरे इन्वेस्टमेंट भी तो 6,000 ही किया ना. 6 crore करो. You invest 6 crore, you will get 6 lakhs. 6 crore. Are you willing to take that loss? So obviously then you have to understand percentage. Don't look at absolute. Look at percentage. कितना percent कमा रहे हो? 2%, 3%. And मैं वापस बोल रहा हूँ, if you're doing any of this thing practically, if you want to after this session also, please target something reasonable. Don't say मुझे double करना है पैसा and all that. The game is about consistency. Don't be a Shahid Afridi, you know. Shahid Afridi अपने अगर क्रिकेट देखा है, and I'm watching IPL as I speak. Shahid Afridi का क्या है? मतलब वो कभी उसका मन करेगा. या Maxwell, if you're watching IPL, Maxwell, what an example of where is his performance? When was the last time Glenn Maxwell has hit a 50? What, 3 years back in IPL? And still there is this Maxwell. अरे क्या किया उसने? I would rather have maybe a small profit, maybe 20-30 runs, but consistently 20-30 runs. Maybe Shubman Gill, for example. You know what I'm saying is, don't go for 30-40% kind of profit in a month. Go for 2%. Do it consistently. In about 1 year, you'll let's say earn 20%. The confidence will go up. Increase your capital next year. Do it for 5 years, 8 years, 10 years. This could just be your livelihood. And I say this to anybody, homemakers, retired people. In a spread, what is it that you will lose here? आपका घर थोड़ी बंद होने वाला है in a 6,000 rupees का loss. But you have to be consistent. That 6,000 रुपए में हमको अगर 1,000 रुपए भी मिले तो मैं निकल जाऊंगा. If the market goes to 12,000 and if I'm making 1,000 rupees, I exit. You do 5 such trades, महीने का 5,000 निकल गया. Investment कितना किया? 30,000 rupees. So not bad. Problem is we ignore discipline. Discipline is the most important thing. If you suddenly start thinking that we are, God, and you invest many lakhs with unlimited risk profile and you're not even watching the market, that is when things go wrong. So we have spreads. You can create a bullish spread or a bearish spread. Like if the market goes down, you want a profit, no problem. You buy a put. This is buy call, sell call. You can do the other way around also. Buy put and then sell put on the lower side. And this website I just showed you because everything is visually in front of you. Analysis becomes easier. You can take informed decision by that. It will tell you how much margin is required, what is the break-even point, what is the premium. Everything is beautifully shown. That's how this sensible thing works. They can also suggest you trade, by the way. This website does a lot of other things also. The website gives you trade ideas. The website gives you their own strategies that you can try. They do a lot. I use it only to analyze my trades. I don't use their trades. But if you want, you can do that also. They will also suggest you trades if you want. But again, that's a website feature. I am not talking about it from a website point of view. So these are some of the strategies which I wanted to tell you about in 1 hour discussion. Obviously, even if you try these 4 or 5 things gradually with practice, I think maybe you will get more confidence about how it works. But I would like to again reiterate, as they show in movies, when the stunts happen, that these are done by professionals. Don't try to imitate at home. Be a little careful is what I'm trying to say. I'm not belittling you. I'm not saying that, oh, you guys cannot do this. I'm not saying that. Just be careful is what I'm trying to say. That is what I came for the session for. Anil sir, you're there? You want to add
Very much there, sir. No, I just want to say that the reason sir does not use the strategies which the website gives is because he himself formulates derivatives. I'm going live saying this, Harish sir and CA Harish sir and CA Somil Parekh, they run their own firm, and day in day out, sir is into derivatives. So this was just to give you all a small idea. As sir keeps insisting, this should be done by professionals. Yes, you can try it out on a simulated model, but you need to get your hands onto it. Sir, how many years have you been practicing and trading on derivatives, respected Harish sir?
14 years.
14 years. So that's about respected sir. We all know he's a chartered accountant. He does wealth management, but this is one more feature of sir. And, sir, no marketing, but I think it's important for colleagues to know the name of your firm, sir.
Edge Zone Capital.
And it's SEBI registered, if I'm not wrong, sir.
Yes, I am a SEBI registered investment advisor. So we do financial planning, wealth management. And for many clients, we use derivatives to them fixed rate of return because we are able to earn consistently doing a lot of things, a glimpse of which I gave, but we do a little more complicated things where the probability of profit goes up substantially and we are able to earn consistently, and we give investors a fixed 12, 13, 14% returns every year. So that's what we do.
And if I remember correctly, sir, you had a product which I don't know whether you're offering it to retail people now, but where the securities are taken, the mutual fund units, etc., are taken as securities, and you take a margin on that. Could you just explain that, sir, just for the understanding of the entire audience, please?
So that product has, so from September, regulations have changed, sir. So no longer is the margin available on the holdings in an easy way. Now it's more complicated because every transaction has to be approved by the client. And most clients don't have the time to keep giving OTPs every time. Now the regulations have changed from September. So now what we have done is we have changed the model slightly, and it is only for HNI's kind of a client where the minimum portfolio value has to be 1 CR and above. And we are creating a digital platform now as I speak. So me and Somil are, as you know, Somil, and you introduced me to him beginning. We are starting a totally digital platform, end to end. Everything will be electronic. So we are developing an entire web-based application for that as I speak. So in the next 45 days or so, it will be live. But it will be still be for HNIs, not for retail. Thank you,
I
Gani,
think
for
Gani has Gani, so good to see you all.
and Ganiji,
Yeah, immediately on the chat,
that website
Gani has
itself,
put
yeah. But just to add, that website itself is on its dying phase. It will probably stay for a week or so. That website is also getting upgraded as I speak. But thank you, Gani, for putting it up.
Thank you, sir. Shreyans is thanking you. Thank you.
Thank you. I
Nice
just hope
session,
all
sir.
of you
Thank you,
understood
sir.
something, and maybe you can try
Thank you very
something
much.
slowly, because the key is to get confidence and then do it over a period of time.
Try with caution. Yeah, better. Thank you. Thank you. Right. Advait also is, sir. Thank you very, very much.
Thank you, sir. Thank you so much.